I'm Larry Walther. This is principlesofaccounting.com, Chapter 22, and in this chapter we're looking at tools for enterprise performance evaluation. Now, this chapter begins with concepts and responsibility accounting and management by exception, which is a broad overview of concepts related to enterprise performance evaluation. By the end of the chapter, we're looking at variance analysis and balanced scorecard approaches to specifically give us tools for executing on the evaluation of enterprise performance. And so responsibility accounting, beginning at this broad level, means that managers must be held accountable for the results of their decisions and the related execution. Performance feedback signals successes, failures, and opportunities for improvement. A manager's area of accountability should align with his or her area of responsibility. That area can be a department, product, plant, territory, or whatever. Attribution of responsibility will usually mirror the firm organizational structure. Furthering, there are different styles of management. A centralized style where top leaders make and direct most of the important decisions in the organization. Lower level personnel are looked to execute on these directives and are generally powerless to make independent policy decisions. This provides strong coordination of purpose and methods, but may lead to the stifling of lower level management talent, suppression of innovation, and reduction of employee morale. Two entirely different thoughts in terms of style of management. The decentralized style is an attempt to respond to the criticisms of the centralized style. That is, top management focuses on strategy, day-to-day operation, decision-making task is left to lower-level personnel. This facilitates rapid frontline response to customer issues, provides for identifying and training emerging managers. It may provide a fertile ground for cultivating new and improved products and processes. However, decision-making is highly dispersed and management performance can be difficult to judge in this environment. The idea of a responsibility is that the part of an organization under the control of a manager is their nexus of control or responsibility area. The assessment of how they're performing depends on the nature of that area of responsibility. There are cost centers, incur cost, but don't generate any revenue. Accounting departments, legal departments, maintenance departments, and so on. These are viewed as cost centers, and the way we evaluate a cost center might be different than the way we would evaluate, for example, a profit center. Under a profit center, the manager controls both cost and revenue. Cost overruns can be expected if it's coupled with an increase in revenue and an increase in profitability. So for a profit center, we're going to be looking at the bottom line of how the management performs within that unit. An investment center is a more comprehensive approach. It's evaluated on cost, profits, and the amount of invested capital that was deployed to achieve the results. So we have different types of activities, and therefore we have different methodologies for considering how they should be evaluated. There's an important evaluative tool that's known as ROI, or return on investment. It's used for evaluating investment centers. It consists of two components, the margin and the turnover. Together, that reduces to a formula that we'll see as operating income divided by average assets. So let's look at a graphic of the ROI calculation. We've got operating income divided by sales. That's simply our margin or our profit expressed as a percentage of sales. And we've got our turnover, or sales divided by average assets that are in use. If we multiply the margin times the turnover, we get our rate of return on investment. Algebraically, as we noted on the preceding slide, this is essentially the operating income divided by our average asset. It's the return on the assets we have deployed in the business. In evaluating an investment center, you would want to look at margin, turnover, and the collective effect of that, or the ROI, return on investment. Recognize that one can affect or improve their ROI by increasing sales, by reducing expenses, and or by decreasing deployed assets. So managers have a variety of tools to work with in terms of trying to improve their performance under an ROI model. This approach encourages a focus on increasing sales while controlling costs and being mindful of the invested amount of assets in the business. However, some profitable opportunities may be passed because managers fear potential dilution of existing successful endeavors. So once again, every evaluative tool has to be considered very carefully in terms of any potential negative effects that can be introduced inadvertently. The concept of nexus of control, as we move up the organizational chart within an organization, Mid and upper level managers assume broader levels of responsibility. At higher steps, individual performance reports are combined to reveal the success or failure of all activities beneath a particular manager. And so when we look at an organizational chart, this illustration corresponds to the book where we have a fast food restaurant chain. We can see that some particular levels of management, such as the CEO and the vice presidents, I've colored them green, they may largely be evaluated as investment centers. The yellow centers would be largely cost centers, such as the food supervisor, dishware supervisor, or procurement manager. And then the blue centers indicate profit centers, our individual store locations, our store management, our catering management. Many times managers such as the vice president of operations, they're evaluated both as a profit center and an investment center. And so this is further discussed in the book, but you can see how different levels of management may be evaluated for different purposes. In any event, our reporting system, the company's accounting system, should support preparation of an accounting report for each responsibility center. This is essential to monitoring, controlling, and directing. It generally results in a comparison of budget to actual results, and as you would suspect, as we move up higher within the organization, the reports tend to include less detailed transaction-specific information and more information about combined results. And so here for Store A, this illustration is repeated in the textbook. Here's our actual results, not only in total dollars, but in percentages of sales. For example, hamburger sales were 40% of total sales. We have our budgeted results. You can see the variances. The bottom line is here we sold less than we anticipated, but we also made more than we anticipated. If you take time to drill down in this data, what you'll discover is that we didn't sell as high a proportion as hamburgers as we thought. We sold more drinks and fries. So total sales were down, but our drinks and fries were our higher profit margin items and actually caused our favorable overall performance for that particular store location. Remember, this individual store is a profit center, and so we can be pleased with the fact that they had profit margins that exceeded expectations despite the faltering overall sales. Now, store location A will be rolled up higher. The next step up the organizational chart is senior manager of store operations. This person's job would be to identify underperforming stores and take corrective actions. Little time is spent on locations that are meeting or exceeding their profit goals. And so here is a roll-up. So we've got store location A, but we also have locations for B, C, and D, and so forth. And we can come up with the combined results of all stores, their total sales, their variable expenses, and their margins. Importantly, there's certain costs, common fixed costs in this case of $1.5 million, that were not allocated to any particular store. And so it's important at the higher levels of an organization that those common costs get rolled into the equation. It may be unfair or cause a mismeasurement of performance evaluation for any particular store, but in evaluating the combined results for all stores, we cannot ignore those common fixed costs. Once again, this will be rolled up higher into the organization, so I say continuing up the organizational chart. The vice president of operations will focus on summary data from the stores, from the catering, and from procuring management. And so here is the stores from the preceding spreadsheet. The results: total sales for all stores, total variable expenses for all stores, the traceable fixed costs for that unit are included there, and we have the margin for the stores that was combined with catering and procurement to come up with the combined results. And again, we throw in common fixed costs that occur at that higher level of corporate organization that are not pushed down, and we've got an operations margin of $2,923,410. The concept of rolling up successfully individual units into higher levels of reporting, such as I've illustrated, supports the concept of management by exception. That is, we enable management to focus on areas where corrective measures are necessary. In preparing our performance reports, remember we had traceable fixed costs. Those would not exist if a unit under evaluation ceased to exist. Those are ordinarily assigned or captured in the performance report of that particular unit. Common fixed costs support the operations of more than one unit. On a store-by-store evaluation, we may not assign those costs to those individual locations, but they're taken into account at the successively higher levels within an organization. To the extent a unit manager is burdened with allocations of common costs, poor signaling of performance can result. In other words, we may have something that's contributing to overall profitability, but not those common costs, and so we want to be careful not to burden that unit with those common costs and draw an incorrect conclusion about whether that unit should be continued or changed, for example. in closing this particular module, let me point out that many businesses have robust accounting information systems or databases. These provide accurate and real-time retrieval of information. They allow detailed mining of data that would not be possible from the static reports that I've just illustrated. For example, this company may want to know about the corporate proportion of sales of hamburgers, fries, and drinks. That could be mined from a database where it would be a little harder to do by looking at the static reports that we've illustrated in this chapter. But clearly the concepts are the same, the results and objectives are the same. It's just the speed to which information can be captured, retrieved, and refined to make more defined decision processes.